So our next chapter called as unit number 4, investment and dividend decisions. So for the first part of the chapter, we're going to deal with investment decisions right now. So starting out with the first format, we are going to calculate, and this is the format for calculating initial investment or cash outlay. Now, whenever we are going to invest or decide to invest in a particular project, that is called as initial investment. Okay, once we decide to invest into a particular project, the immediate capital that we invest into it, that's called as initial investment. Now, this format is to find out how do we calculate the cash outlay or initial investment. So, what is the amount of expenses that has to be added up in order to come to a final conclusion called as initial investment? So, the format goes like this. First, we're going to add up with cost of sales. So, what is the exact amount of the sales made? To that, we are going to add up any kind of installation charges for that particular project, any kind of insurance that we have taken up, transport facilities, any duties like export or import duties or octroi charges, all those duties, and the financing cost, right? So all these expenditures we are going to add up to the amount of sales made. Opportunity cost, that is the cost that is incurred if we have let gone of another project. That is called opportunity cost. If there's any, you can add that up. And additional working capital. So in case you have added another amount of set of capital to the project, that will become additional working capital. So you're going to total it up from the sales, installation, opportunity cost and the additional working capital, add it up to the sales, and then you're going to deduct the scrap value. So in case you need to sell that out, or the residue that is left over for the project or the asset, okay, what is that scrap value? If it is mentioned in the question, if it's given, put up that value in this place, and then you can minus that from the whole of the total and then come up with called as amount initial investment or cash outlay. Is that clear? So this is the format. From sales, you're going to add up the expenditures and decrease the scrap value. So this is the format for calculating your cash outlay or initial investment. So next up, the format is format of calculating net cash inflows and operating cash flows. So after we have spent everything for a particular project, what is the return that we are getting from the investment revenue or from the particular project, right? So that is what we are going to find out. Now this is the format for that. We're going to start with sales. We're going to deduct the expenditure such as variable costs and fixed costs. So just the last chapter called as financing decisions, we have in detail known about what is variable cost and what is fixed cost. So those expenses we're going to deduct from the sales revenue. Then we arrive at earnings before depreciation and tax. Little bit the format is different, or the terms used are different from what you've studied in financing decision. Just that here I'm including depreciation here and not interest. Okay, interest we used to conduct or consider in financing decision. Here I am considering depreciation and tax mostly. Now here if you can see, it's called as earnings before depreciation and tax. So this is the basic earnings of the company. From the sales I've deducted variable cost, fixed cost. What I arrive at is called as earnings before depreciation and tax. So from this earnings, I have not charged depreciation, I have not charged tax. That is why it's called as earnings before. Got it? I have not charged both. And then I'm going to charge depreciation. What is depreciation? It is the decrease in the value of an asset or a machine. Is that clear? Or a furniture. Over the period of usage, the utility of that particular asset is going to be reduced. That I'm going to term it as depreciation. Now once I decrease depreciation from EBDT, it's called as earnings before tax. That means I have deducted depreciation. Now whatever earnings that I have not deducted tax. That's called as EBT, earnings before tax. Then we deduct tax, which will be mentioned in the question, the percentage of tax. Then we call as earnings after tax. That is profits where I have deducted depreciation, deducted tax. So it's called as earnings after taxation, EAT. The last part, we are going to add back depreciation, and which the last thing is called as cash flow before depreciation and after tax. In short, it might be called as cash flows before depreciation and after tax, or you can call it as earnings before depreciation after tax. I want you to remember each of these short forms mentioned here, okay, because that's what you can easily register in your minds. Now, one question is, we are decreasing or we are deducting depreciation in this place and we are adding back here. What is the reason is, now as per the format laid down by the SEBI or by ICAI that companies have to follow, in that format, yes, you need to decrease or you need to deduct depreciation. Now let's understand what exactly is depreciation. We have known the meaning that depreciation is the decrease in the value of an asset, correct? Now that is the decrease, that amount I'm putting it as depreciation. Now answer me, if depreciation, if let's say I'm quoting here it as 5,000 rupees, depreciation is 5,000 rupees. Is 5,000 rupees money or amount going out of my business? Is there a cash outflow of depreciation 5,000? No, there is no physical cash outflow of rupees 5,000. Instead, there is only a reduction in the value in my books of accounts. So, we commonly call depreciation as the non-cash expenditure. Is depreciation expenditure? Yes. But is it cash expenditure? Is there cash going out amount of 5,000? No. But am I deducting from my earnings? Yes. So yes, it is an expenditure, but yes, it is a non-cash expenditure. Got it? So that is called as depreciation, a non-cash expenditure. This as far as here until we arrive at EAT. Okay. Now this much is according to the format laid down by the ICA authorities. But then why am I adding back here depreciation is because now this amount, whatever amount that I have, 5,000 or 10,000, it is not actually going out of my business. 5,000 is still with the business, correct? Now here I am calculating cash flow before depreciation after tax, that is what is the amount of funds that is left in hand for the company, either in hand, cash in hand or cash at bank. What is the exact amount? How do I know that? Only when I add back what I have deducted here. But why am I deducting here? As a format. Why am I adding back here? To know my exact cash in hand or cash at bank. Hope the concept is clear. Why we are deducting here and adding back here. Is that clear to you? So this is the second format that you need to learn. Format for calculating net cash inflows or operating cash flows. So we have completed two formats. Now we'll be moving on to the techniques of capital budgeting. So in this chapter or under the topic of investment decisions, we have 5 different techniques to be learning in detail, starting with payback period. In short, it's called as PBP, net present value, that is NPV, profitability index PI, accounting rate of return ARR, and internal rate of return IRR. So these are the 5 different methods how you can find out that whether a certain project is profitable to you or not. Okay, starting with payback period and to internal rate of return, these are the different techniques as to find out or to decide for a management of a company whether or not this particular project is profitable venture or not. So based on these calculations or these techniques, a company decides to invest into a particular project or not. So let's look at each technique in detail, starting with payback period. So let's start with the first technique called as the payback period. As the name itself says, pay back. That means whatever original investment that we have invested into the project or a business, how long will it take for that investment to recover? That's the concept of payback period. Number of years to recover original investment. So whatever initially we have invested, let's say rupees 10 lakh, how many years would that take for my investment to recover? That's the concept of payback period. Now we have two circumstances here. One is even cash flows and the second is uneven cash flows. I'm sure you have known in time value of money we have studied under annuity, even cash flows, uneven cash flows, if you can recall. There, what is even cash flows? Same is the meaning over here. That means it is the same amount that you're getting back as a return. Let's say it's amount of 50,000. Every year 50,000 is your return on investment. That is called as even cash flows. Opposite uneven cash flows, it's different amount in each year. 50,000 one year, maybe zero in the next year, and next year it might be negative, and then next year it might be 1 lakh, and so on. So the amount of investment is not equal, or it's not the same. So if there is even cash flows, what is the formula? Payback period equals to original investment divided by annual cash flows. Let's say the life of the project is 10 years. The investment you've put in here, 10 lakh, and the annual cash flows, whatever you're going to be receiving, that also you have to divide it. So original investment divided by annual cash inflows. Once you divide that, okay, each year, let's say you're getting 2 lakh rupees. 10 years is the lifetime. Original investment is 10 lakh. Every year your return on investment is rupees 2 lakh. So once you're calculating original investment 10 lakh divided by annual cash inflows, every year how much are you receiving? 2 lakh rupees. So 10 lakh divided by 2 lakh. What will be my answer? 5 years. So within 5 years, my original investment or my initial investment I will be recovering. So the rest of the 5 years, whatever return I'm earning, it is entirely profit. Is that clear? So first 5 years, whatever I'm receiving, it's just my initial investment. The next 5 years, what I'll be receiving is called as my profit. Now, not necessarily this will apply to all the projects. Some projects you might get your original investment within 2 years. Some might take 8 years, and so on, depending upon the project. Second, uneven cash flows. The formula is year before full recovery plus amount yet to recover and the next year cash flows. Now just remember this formula. This here I cannot explain, but when the problem we are solving, there you will understand it better. So just remember the formula. For uneven cash flows, the payback period calculation equals to year before the full recovery. Means that original investment before that. What is the year? Plus, here I am calculating only the year, not the amount. Year before the full recovery. So 1, 2, 3, 4, whichever year it is, that I am going to write it. Okay. Amount yet to recover. That is the amount. Rupees I am going to write it here. And the next year, cash flow. That again is going to be your year and not amount. It's going to be year and amount in terms of rupees. Is that clear? This is the concept of payback period. Here's the meaning. Number of years to recover original investment. 2 circumstances, even cash flows and uneven cash flows, and 2 formulas to be learned. So first question, starting with the payback period. The given details in the question are: original investment of the project is 4 lakh rupees and the annual cash flow, ACF stands for annual cash flows, are 50,000. So that means it is even cash flows, right? If it is uneven, there would be more amounts given. Since there's only one amount given, we understand that is a even cash flow, the first circumstance. So what is the formula for even cash flow? Original investment divided by annual cash flows. 4 lakh divided by 50,000, we arrive at 8 years. So that means that this project, how many years does it take to recover your initial investment is 8 years. It's going to take 8 years just to recover your original investment. Any return that you get after 8th year, that will become your profit. Question number 2, the given details are original investment rupees 10 lakh and earnings before taxes 5 lakh rupees. Now EBT means they would have considered depreciation but yet to be considered tax. That is the stage of EBT means. But for profit or for payback period, what kind of earnings or cash flows we require is earnings after depreciation before tax. This is the earnings that we require for payback period. So in order to arrive at this answer, we need to do the calculation. Starting with earnings before tax that is given in the question, and they've given the details of depreciation at 12% rate and tax at 50%. So earnings before tax rupees 5 lakh. What do we deduct after earnings before tax? We deduct tax. What is the percentage? 50. So half of 5 lakh is 2,50,000. The remaining 2,50,000 will be carried forward as earnings after tax. As we always say, depreciation is a non-cash expenditure. So I need to know exact amount of cash in hand. Therefore, I am going to add back, not minus, add back depreciation at the rate of what? 12% on what? Original investment. So 12% on 10 lakh is 1,20,000. So I've calculated my depreciation and I'm adding it to the earnings after tax. 1,20,000 added to 2,50,000 arrive at earnings after depreciation before tax at 3,70,000 rupees. So this is going to be my annual cash flow for the given project or investment. So here, coming back to the formula, original investment divided by annual cash flows, 10 lakh divided by 3,70,000 arrive at answer 2.7 years. So how long will it take my original investment to come back or recover? 2.7 years, almost 3 years is the time taken for the investment to be recovered. Okay, moving on to the next question. Question number 5. The given information is original investment rupees 1 lakh and the cash flows for the first 4 years are 30,000, 40,000, 20,000 and 10,000. That means it is uneven cash flows. Every year you're getting a different amount of cash flow. So how do we solve the uneven cash flows? We need to prepare a table like this. Year, cash flows and cumulative cash flows. The first year, all the 4 years you're going to write it. Cash flows given in the question, right, as it is, and cumulative cash flow. How do you calculate this? 30,000 for the first year, write as it is, and then you're going to add 30,000 plus 70 plus 40, you will get 70,000. 70,000 plus 20, 90,000. 90,000 plus 10,000, 1 lakh. Okay, so that is how you have to calculate your last column called as cumulative cash flows. And now, if you have to, what is my investment here? 1 lakh. When have I recovered here? Yes. So that's why I have highlighted the last year cash flow. Got it? So my payback period equals to 4 years. Now why am I not using the formula here is because it is directly known. Investment is 1 lakh and when I'm calculating the table directly, I'm able to identify when or which year I'm able to recover my original investment. So when original investment is recovered directly, that is in a table only if we can observe, then there's no need of using the formula to find out the payback period. So we write the answer payback period equals to 4 years directly. In case, let's say this cash flow was 20,000. Okay, then this would become 1,10,000 rupees. Then we might have to use the formula given for uneven cash flows. Since it is not and it is matching with my original investment, I don't have to repeat the formula again. Directly I will just write 4 years here. Now we are going to look in the upcoming problems what if the amount changes and then how to use the uneven cash flow formula.